Now that the world has calmed down and the bedwetting of a week ago has departed and normal transmission has been resumed, I thought it would be worth looking at our recovery week and seeing how it unfolded. If we go back to the catalyst, the Nikkei 225, we can see that the Nikkei had a high in mid-July, then fell away from that quite sharply. And you can see this series of gaps and the two very damaging downward sessions that we had. Markets then bounced a little bit and is attempting to recover. I'll say a little bit about that in a few moments. If we break down the performance of the Nikkei from that high point in July, we get the following distribution of returns. The damaging sessions are quite clearly obvious, as is the recovery session. So we had that very bad session on the 5th, recovery session the next day. The market has continued to recover post that event. But if we look at the Nikkei from a technical perspective, on the move down we see a series of gaps. These are quite damaging. We have that disastrous session, followed by a recovery, followed by another recovery, and two of those gaps have been filled, but last week's session was not the most vibrant of sessions, and it will be very interesting to see if the Nikkei has not had the wind taken out of its sails on a more permanent basis, because based upon the last 4 sessions, the performance of the Nikkei has been quite ordinary. These were ordinary trading sessions. Granted, markets always need a little bit of recovery space after taking such a belting and then bouncing so hard. But the thing we have to be wary of is what is known as a dead cat bounce. For those who are unfamiliar with the term, a dead cat bounce is exactly what it says. You take a cat that is dead, you throw it at the ground really hard, and it will bounce. This is what may be unfolding in the Nikkei. And the unwinding of the yen trade might have taken the sales out of the resurgence they had been enjoying. If we look at the S&P 500, we see a different picture. This is what a robust market recovery looks like. You can see a series of downward gaps and some nasty sessions in there, but you can see a strong recovery. Each one of these candles is quite strong. It's quite vibrant and energetic. Yes, poor session on Thursday, good session Friday. And the market is pushing back towards that high. The push back towards that high will be very critical. It will be something that is very much worth watching. If we look at the internal structure of the S&P 500, as I mentioned before, when looking at these sorts of situations, before you rush to judgment as to whether you should sell everything you own and move into cash, you have to understand the internal dynamics of the market and see what they are doing, because they will tell you everything you need to know. So if we look at a heat map of the S&P 500, there's one or two things that are interesting here. What is interesting immediately is the somewhat mixed performance of what used to be called and still called the Magnificent Seven. Nvidia and Google were very strong. Microsoft and Meta very poor. But the other thing to note is the strong performance of stocks away from those 7. So Eli Lilly, J&J, Berkshire Hathaway, and the like are diversified out of that tiny little group. So the recovery was more widespread than simply being concentrated in a handful of stocks. Yes, Nvidia going up 6% never hurt any market. If we take another look at the granularity of the market, what I've done here is I've mapped 52-week new highs, 52-week new lows, and this is a simple count. So this is not cumulative. This is not like the next chart we'll look at. Green line, as you would expect, new highs. Red line, new lows. This is the picture of a market that is strong. It is indicative of strength, because you see the market continually making, or the market components continually making, new 52-week highs. And so each period we get a new count of 52-week highs and not 52-week lows. My expectation would have been that if the market was going to come apart at the seams, that we would have had a spike in the new 52-week lows, that's what we would have seen. That would have been our early warning system, and that would have shown up here in the cumulative new 52-week high-low line, and it hasn't. There is a small blip, but it's not really much of a blip, and the market has continued to move forward and continue to demonstrate strength. This is what a strong market looks like. This is what a market that is doing well looks like. If we look further afield in the US and we have a look at the NASDAQ, NASDAQ presents a similar picture but is less robust. And there is that very nasty session on Thursday. So we have our gaps down, reversal, climb out, nasty session on Thursday, indecision Friday, which is problematic. Your expectation or your want would be for this to motor back towards that previous high in July. But at present, it hasn't done that. So if we look at the internal dynamics of the NASDAQ 100, it's a mixed bag, and much of this data is transferred, as you would expect, from looking at the S&P 500 because many of these stocks are cross-listed across indices. But what is interesting to me, what immediately stands out, is that Amazon was neutral for the week. It really went nowhere. And there's a smattering of going nowhere, doing well, and one or two doing quite well. What is interesting is the bounce in Tesla. Again, if we apply a very granular approach to this and we look at a simple count of new highs and new lows, this is what we see. You can see very much the strong point of the market was this period, November, December, February, January, March, and the like. It's not now. The market has slowed a little bit and is not demonstrating that energy that it did. So if we look at cumulative line, similar picture to the S&P 500, it is still robust. It is still a market that is pushing forward. Whether it pushes forward back through that high of July is something we'll only know when we see it happen. If we look internally, if we look at our market, we see pretty much what we would expect from our market. We played follow the leader. We had those two disastrous down sessions. Market's now attempted to recover. But once again, it is not pushed forward vibrantly, and to some degree this harks back to a blog posting I made last week about what a healthy market looks like. And our market, from the perspective of looking at the leaders within the market, is not a healthy market. I could probably be cynical and say, really, pretty much according to the leaders, it has not been a healthy market for 2 decades. So we're back to this notion that the Australian stock market is a special situations market. It is a trader's market. Granted, some of those trades might go for a year, 18 months, 2 years, but you still have to know how to trade. Simply taking the advice of your stockbroker and buying all 4 major banks will probably see you collecting the pension in your old age. If we look at the internal dynamics of our market, you can see it looks different instantly from what we saw with the S&P 500. The S&P 500 was predominantly green. Ours is predominantly red. Ours is predominantly ordinary in its performance. And this to some degree is a reflection of the construction of the ASX 200. It is a reflection, as you would expect, of the stocks that are in there. These, by and large, are not vibrant, profit-making stocks for the trader. They're not even profit-making stocks for investors unless you've got 30 years to sit there and wait. So this is pretty much what I would expect. Market pushed forward by a handful of stocks, most riding on the coattails of that, and attempting to be positive, attempting to generate some sort of energy. If we look at a much broader picture, so we try and put this into context, we see that the index broke out of this congestion that it had been in for almost 3 years, but the breakout from the congestion has not been that convincing. there are these constant attempts to test support along the way. What you would want to see from this, from an investor's perspective, not a trader's perspective, is for this simply to break up and keep going. It would hark back to the period of, let's say, 2003, 2004, where it's clean and clear in the way it presented itself. It was not this noisy aggregation of fairly modest trading periods. So if we look at new 52-week high lows for our market, this is what it looks like. I've included the period of 2020 in there for the COVID pop. I've done that because I want to give you an idea of what a market that falls apart looks like. Our market's not falling apart, it's just moribund. You have to be selective in the opportunities you look for. To reinforce this notion that the market is not falling apart, this is the ASX 200, and it's the ASX 200 52-week high, 52-week low cumulative line from the GFC. You can see that you are given fair warning that the market is coming apart at the seams. This harks back to points I've made before. Market crashes don't just suddenly happen. You don't just wake up one morning and you find that the Dow has lost 50% in a session. It doesn't work that way. Whilst fear is a powerful motivator among traders and investors, it takes a little while to get going. There are always those who hang on, and it's those who hang on who are slowing the fall down for the rest of us and giving us opportunity to get out. So this brings me to my final point, and perhaps the point that is germane to all of this that I've been talking about, and that is this notion that the market will tell you everything you need to know. I have a very buoyant metaphor for the market. And my metaphor is that the market will present me with boundless opportunities. And it doesn't matter which market I'm talking about. And it will continue to present me with those opportunities until the time I pop my clogs. But also in doing so, it will tell me everything I need to know. I don't need to know anything else because it has told me everything I need to know. The great problem, and this is the great problem from fund managers to market commentators to financial journalists to amateur investors, they simply don't listen because they've got their head up their asses. They've already decided what is happening. So they can't be told what is happening. They already have a narrative that they've crafted. And what they do is they look for evidence that supports that narrative. We're back to this notion of the narrative fallacy. If you just learn to listen to what the market is telling you, you will be surprised at how much it will tell you and its generosity in telling you.